Well, hey, welcome back. I'm Dave Dubeau, and today we're going to be talking about how much money does a real estate investor make? Now, it's all over the board. Some people make a lot of money, other people don't make very much. It really depends on a number of different factors, including how active you are, the style of real estate investing you're doing, whether you're focusing on short-term deals or long-term deals, small deals, big deals, turnkey properties, or if you're focusing on fixer-uppers. That's what we're going to be talking about here today. So how much money a real estate investor makes really depends on lots of different things. What kind of deals you're doing, the time frame of the deals, the money involved in the deals, the size of the deals, whether they're turnkey type properties or fixer-upper type properties. We're going to be taking a look at each one of those in this episode. All right, so real estate investing, like every industry, has a variety of different players. And they're all the way from one end, which is people just getting involved and doing creative type stuff and very transactional type thing, all the way to the other end, which are folks that are investing in very, very large real estate deals for the long term. It's really going to depend on what you're focusing on. So a lot of people that get started in real estate investing do the creative type stuff. So they're doing very transactional things like bird dogging, for example. So a bird dog is somebody who goes out and looks for potential deals. It might be somebody that's doing some other kind of work, like they're delivering newspapers or they're delivery people or whatever. And if they find a property that looks like it might be a good fix and flip type deal, then they'll take pictures of it, do a little bit of research about that, and then provide that information to a more active real estate investor in exchange for a small fee. Maybe it's $100, $200. It really depends on what they're up to. So it's just something that they're doing on the side. They're kind of on the edge of real estate investing, but they're not really investing just yet. Next step along those lines would be somebody who's doing wholesale deals. So they go out and they find really good deals. They get them under contract. They tie them up. They make sure that there's a good profit in there for the end buyer. And then they sell the contract to an active real estate investor, usually a flipper or somebody like that, and in exchange for a fee. Now, usually this is much higher than what a bird dog would make because, again, the wholesaler has done a lot more work with these. They've negotiated the deal. They've got it under contract. They're handing the contract over to somebody else. So the fee might be $2,000 or $5,000 or even $10,000 or more, depending on how much profit there is and the size of the deal. But again, very, very transactional. So how much money those folks are going to make is really limited by how many deals they do and how often they do those kind of deals. Same thing when people are getting into creative type strategies. Like back in the day, I did a lot of creative type deals, and then I got into rent to own type deals. And if you're a flipper, again, these are all transactional type real estate investments. So you're in and you're out. You know, if you're doing a flip, you want to be in and out ideally within 3 to 6 months. If you're doing creative type deals, same kind of idea. So that's great for quick little pops of cash, but there's no real long-term play in there. You're not taking advantage of all of the different multiple profit centers in a real estate deal. So again, how much money you're going to make if you're doing those kind of strategies depends completely on, number one, the market area that you're doing business in, the average price of properties. Number two, the volume of deals that you do. That's going to depend on how much money you make in those kind of strategies. So those kind of strategies tend to be short-term type deals. And typically the shorter the term of the deal, the smaller the profits. It just makes sense. If you hold on to a property long-term, then you get to benefit from all of the different profit centers in a real estate deal. You benefit from instant equity. You benefit from mortgage pay down, which really, really starts to kick in, especially after year 5. You benefit from market appreciation, the natural increase in value of prices of property over time. You benefit from the cash flow in the deal, the difference between your income and your expenses every month. You benefit from depreciation. That's usually a tax type benefit. You benefit from leverage. You benefit from reinvestment. You benefit from all of these different profit centers in a real estate deal, depending on the length of time that you hold that property. So the longer you hold the property, typically the more money you're going to make. Now, the other obvious thing that makes a huge difference on what kind of deals, what kind of money you're going to make with real estate investing is the size of the deals that you're doing. So way back in the day when I was doing creative deals, some of the properties I was working on were little mobile homes and mobile home parks, which is great. But at that time, I might make $2,000 or $3,000 or $5,000 on a little deal quite quickly, but not much more because at that time, quite frankly, those properties weren't worth more than $15,000 or $20,000. Now, on the other hand, if you're doing much bigger deals, like you're doing multifamily type properties, you're doing development deals, you're doing much bigger deals, you're dealing with much bigger numbers. And even if the profit margin's small, you're still making a lot more money with bigger deals. So again, the size of the deal, the length of time that you're in the deal is going to make a huge difference in how much money you make on those kind of properties. Now, here's something that's kind of interesting. It's a little bit counterintuitive. Sometimes you make more money with smaller deals than you might make with bigger deals. What do I mean by that? So for example, let's say you're doing a small multifamily BRRRR deal. So you buy it, you renovate it, you rent it, you refinance it, you repeat that. Let's say you're doing that with a duplex, a triplex, a fourplex, something like that, and you're working with one investor partner. Well, your profits and your investors' profits on that deal could be a lot bigger than if you were doing a large multifamily development type deal or a large multifamily syndication type deal. Why is that? Because with these large syndications, typically it's a bunch of partners working together on that, and they're working with a ton of investors. So there's a ton of investors involved, and those investors typically get a much larger piece of the pie of that deal to make the numbers make sense for them. So whereas a small deal might be a 50-50 profit split, a large deal like that, 80% or 70% of the total profits could very well be going to the investor partners to make it attractive for them, and 20 or 30% of the profits could be split amongst all of the active partners in the deal. So you'd be getting a much, much smaller little piece of the action with that big deal than with the BRRRR deal. Does that make sense? And the other thing that makes a big difference on how much money you're going to make as a real estate investor is whether you're focusing on properties that are ready to go or turnkey type properties where basically you just buy it and you rent it out and off you go, or if you're focusing on properties that need some TLC, they need some renovations, they need to be rehabbed, they need to be spruced up in order to make them top market value. So if you're focusing on turnkey type properties, typically there's a lot smaller profit margin in those because whoever it was that brought the property up to snuff is taking a big chunk of the profits for doing all of that work. On the other hand, if you're doing something like a BRRRR type deal where you're renovating the property and bringing up the value, then you get the benefits of that in addition to the long-term profit centers that you get from holding onto that property over years. So it really depends on what kind of deals you're doing, the size of deals, the location of those properties, the kind of properties that you're focusing on, whether you're doing short-term type deals or longer-term type deals, if you're doing turnkey or if you're doing properties that need to be renovated or developed. That's why all sorts of different real estate investors make all sorts of different amounts of money. It really depends on what you want, what your goals are, and how much effort you're willing to put into it. Now, speaking of investors, if you're looking for a proven way to attract joint venture partners and to attract investors to you and your deals, then I'm going to recommend you get a free copy of my book, Money Partner Formula. You can click on the link that's in the description below or go to investorattractionbook.com. And this is going to walk you through my whole process for attracting investors, bringing them to you already pre-qualified, predisposed, and interested in your deals without you having to desperately chase after anybody, without you having to cold call people. It's all about attracting investors, raising 6 figures in a matter of weeks and even 7 figures in a matter of months. Go ahead, get your copy today.